Thank you. Yes, we do have a little bit of crossover with the previous panel, but we obviously have a very different team of esteemed panelists here, so a slightly different perspective. And this panel is going to focus a little bit more on the oil side of the equation rather than the offshore wind side of the equation. In terms of panel introductions, we don't have a very long session here. We've only got half an hour. I don't want to waste too much time introducing everybody. What I'll do is just let the panelists very quickly introduce themselves. Gents, if you don't mind, if you could keep it to one breath, if you take a big breath and introduce yourself, and keep it to kind of 30 seconds so we don't eat too much into the session, but just give us a quick taste of who you are, that'd be great.
George Kypraios, Yefira Group, ranges of debt and equity and M&A in the offshore space.
Christoph Toepfer from Borealis Maritime and also Australis Maritime, owner and lender in this space.
Hi, name is Lakhjit. I'm with Glander Fuels. We are covering more on fuel supply trading, back-to-back trading, and on lubes as well.
I'm Vivek, Khabya from Arus, Jaya Oil and Gas. We predominantly charterers. We charter vessels for projects and work with EPCIC contractors to help them execute projects.
Hi, I'm Thom Payne from Westwood Global Energy. It's market intelligence commercial advisory services focusing on offshore energy.
Hi, my name is Chong Su. Yes, I'm Atlantic Navigation. Our operations are mainly in the Middle East. So glad to meet you all.
Thanks, and I'm Andrew Nimmo, partner with Watson, Farley & Williams here in Singapore. So it's really nice to be able to sit here and actually say some positive things about OSVs. As we all know, the last few years it's been pretty challenging, but where we are today, rates are picking up, utilization levels are going up. We saw from Martin's slides earlier from Rystad that the picture for the kind of medium to long term towards the end of this decade also looks very good from the figures. So things are certainly looking a lot more positive. Having said that, OSVs are still a challenging space to operate in. They have their own unique challenges when it comes to financing, which I'm sure will come out from the panel discussion as well a little bit later on. And there are clearly some divergent views in the market in terms of where things go from here, demonstrated by the uptick in sale and purchase activity. The latest figures I read that we were 60% up year on year in terms of sale and purchase activity in the OSV sector. So there's clearly differing views being taken by owners in terms of where we go from here. So it's a complex picture, and maybe to give us a bit of an overview of where we stand at the moment and the current trends that we're seeing, can I hand over to you, Tom, to give us a bit of an overview of what you're seeing?
Thanks, Andrew. Yes, so certainly it's a positive situation. I mean, fundamentally it's driven by high oil prices, as we know, and the expectation is we should be with these high oil prices for quite a while. I think the OPEC Plus bloc has been surprisingly aggressive in trying to keep those prices in that $75 to $80 range, and that's kind of the range that we're using to forecast levels of activity across the offshore oil and gas sector for the next 4 to 5 years at least. That's of course seen a massive uptick in investment, but we've heard a lot today about the rise of ESG and other geopolitical issues, and really what that's doing is creating a less global and a much more regionalized market as well, and that seems to be a fundamental structure that we're going to have to kind of live with in this next cycle. We are seeing an increased amount of investment in certain markets, which will be fundamental in us reaching an incremental 2 to 3 million barrels a day of oil supply, which is probably the consensus view of what we need by 2030. And again, those markets, no real surprise that it's the Middle East, where we've seen a massive, unprecedented uptick in investment in new infrastructure, and selected other greenfield markets across Latin America, while other markets are still kind of straggling behind. And what that means is we're hearing a lot about the OSV sector being very busy, and we can look at slightly larger markets like the rig market, where there's of course a greater kind of transparency of data. We can look at drill ships, which are effectively sold out. There is a committed utilization of around 95 to 100% right now. That means you cannot secure a drill ship today. And we're seeing people looking for rates in that kind of $450,000 to $500,000 a day, which is basically what we were seeing in that 2013 to 14 levels. So it's always quite a good kind of precursor to what we would expect in the boat market. What we're seeing in the rig market, and we're seeing a similar story, of course, in jackups, but again, very localized in the GCC and the Middle East. So it's, you know, we are hearing about this tightness, and we'll talk about that in due course and which markets are tight. But what it means is that there are vessels in the market. They're not necessarily in the right place, and they're not owned by the right people, which is why you're seeing the flurry of M&A and the flurry of S&P. There are still, by our count, around 650 stacked vessels. Around a third of those are less than 15 years of age, so there's still some tonnage to be moved around. And there are still some vessels looking to be delivered from Chinese yards, although that number is dwindling very quickly, around maybe 35 to 40 by our count of vessels, which realistically can enter the market, but again, not necessarily the right types of vessels these days. So we're certainly seeing fundamentals that are supportive of increased levels of activity in the OSV sector. We're certainly seeing tightening in certain markets, again in the GCC, potentially for the larger PSVs in Latin America, although West Africa and North Sea are also showing very good times as well. In this part of the world, things have been a lot slower. A lot of debate between managers and E&Ps trying to get those rates to match what we're seeing in other parts of the world. And we do expect to see further kind of exodus of vessels moving to those regions that I mentioned. So maybe that's a bit of a scene setter, but we'll get into more detail as we go along.
Great, thank you. And in terms of, you mentioned the Middle East there as a market. Chongping, does that match and tally with what you're seeing?
We are certainly no experts. I think you heard from the expert. You can only say that, look, the market has been very strong. I think the recovery started in the second half of 2021 when oil prices average was about 80 bucks per barrel. Then 2022 is spiked up to 210, and now we're seeing about 85. I think the market is volatile, but I think at that kind of prices, we're seeing a lot of demand. And one of the competitors of offshore oil is onshore oil. And now we're seeing that there's a lot of impetus in trying to drill the offshore oil, such that to deplete that. I think that's for energy security as well. But we are seeing a lot of ADNOC, Saudi Aramco. There's a lot of derived demand for our vessels, and we're seeing about 95. Or in fact, most of our competitors or even our industry peers, we are looking at more than 95% utilization.
Pass the mic. In terms of those high utilization rates and tightness on the demand side, how much of it do you think is due to an uptick in the oil side demand, and how much of it is due to vessels moving across to the wind sector and perhaps being converted for use on offshore wind projects? I don't know if any of the panelists have any view on which of those has the greatest weight. Christoph?
It's probably difficult to break it down what has a bigger draw on the supply side, but for sure the wind market will continue to draw tonnage. I think in the anchor handler space we only see the beginning of it, and that's going to be turning out to potentially having quite a bit of draw onto the anchor handler market in the next 3 to 4 years. But it's not just the wind market. Also, we have seen. I mean, we ourselves have sold one PSV into conversion to a fish farm feeding vessel. We have seen conversions to cable layers. We have seen conversion into walk-to-work vessels. So there's a lot of conversions that have happened. They become a little more difficult now because the PSV prices have increased, and so new builds start to come into the mix again. But then you have the lead times on the new builds. So there's been quite a bit of draw onto the existing tonnage, and now these new sectors coming up that continue to draw as well. So it's difficult to quantify, what's the bigger effect of it. But all of these things combined, plus virtually no order book anymore. I think I'm surprised there's still so many vessels apparently in China. Those that are still maybe for delivery are mostly really for maybe Chinese market or so, not really for the Western market, because that order book is gone. And we haven't seen any orders yet. We expect some orders to develop during the course of this year. Particularly with focus on maybe the Middle Eastern market, because that market seems to be, really sucking in a lot of tonnage from all areas.
Yeah, we were going to come on to the topic of new builds later on, but since you mentioned it, let's address that now. I mean, some of the pricing for the new builds is obviously looking quite toppy at the moment. It's quite expensive tonnage, and in some respects, for some vessel types in particular, quite difficult to. You have to have some very robust forecasts going out to make the figures work. Do you think that's going to have an issue going forward in terms of supply side? Do you think we'll get to a point where it's going to be a difficult decision for people to actually see if it's worth investing the numbers that we're talking about?
I think we're still far away from speculative orders. I think the only orders we're going to see developing are against contract, also because prices are quite high. The European yards are those that have the capability to build offshore vessels are also quite busy now with the wind market, and so that makes it quite a tight situation. So the other thing is obviously also on the speculative side, you know, the owners who traditionally would have placed these kind of orders are maybe not yet financially again back in the situation where they can do this. We can touch on later on probably also on the financing side, the lack of financing for new builds as well. And that will keep the order book very, very small for quite some time. That's what we expect.
But I guess that could also be a positive thing in keeping a lid on things and stopping things getting too hot, keeping the market at a sensible pace. What's the view of the panel in terms of the increased positivity and how long this is here to stay? Do you agree with the figures we saw from Rystad earlier that the demand side is looking very good and things are looking good right out to the end of the decade? Do we think this could be a false dawn? What's the general view? Vivek, do you have any thoughts on that?
I think this positivity this time is for the near future. Definitely 3, 5, 7 years. Yes, it's there to stay. A lot of factors coming in: oil demand requirement, pent-up demand, shortage of vessels, a lot of investment that in the new development of fields which had stopped during the COVID years is now coming back. So maybe between 100 200 billion a year going into new field development, which will require support vessels, and then we have the shortage of support vessels for that kind due to various reasons: financing, new building constraints. Steel is, I don't know, is all-time high. Steel is high, so the cost of vessels are at one of the highest levels. So break-even points at that, and again the ESG guidelines. Because of that, we'll see banks being reluctant. Singapore, I think, is nil, nearly nil at financing. I think the Singapore banks have taken it a little too far. To give you a personal example, my company is Arus, Jaya Oil and Gas. To buy my own office in 2019, I was rejected a loan, oil and gas, sorry, negative sector. So even to buy an office space, the loan was rejected. We had to reclassify it as a consulting company and not for own use office. It's an investment, and then got it in financing and an investment from a third bank after being rejected to two. So yeah, the Singapore banks have taken this ESG too far, but it's catching up across most banks globally. So I think with those constraints, and coming back to the OSV sector, I think this positivity will be here to remain. It's a little challenging for people like me because we sit in the middle of the owners and the EPCIC contractor, and managing expectation on both sides is a very, very challenging times for us. Tough, because the owners are expecting rates to go higher and higher and higher, 50, 60% already up. Some expectations are 100% up. EPCIs, the oil majors are not there with that kind of budgets. They have priced in budgets which are much lower. So we are seeing this back and forth a lot. So yeah, but yeah, OSV positivity I think will remain here. From an oil price perspective, we have seen if it goes too high, we see oil production go up. If it's too low, we have seen OPEC come and support it with cuts. So I think this 80 plus minus oil is here to remain, and that's going to give us a good run for some time to come.
Be interesting to see how that pans out. The latest OPEC cut did have an immediate impact on the price, but it quickly petered out. So it's interesting to see how that one will play out. You mentioned the financing. That was what we were going to come on to next. The question was really whether the positivity is following its way through to the financiers yet. I think you've you've made it clear that from your perspective that's still challenging. We all know that some of the banks in particular have been burned in the past in this sector and maybe reluctant to come back in some cases. OSVs are slightly tricky to finance in some respects, in particular where they're operating in difficult to bank jurisdictions with cabotage laws applying, etc., which may not be the most popular flags sometimes to finance from the banking side. And obviously that combined with the relatively short-term contracts that are prevalent in the sector does make it challenging. George, what are you seeing on that side? Obviously banks are reluctant in the space, but how much appetite is there?
The great thing about a back-to-back session is I can associate myself with things that Ali said and Joachim and others. So If I don't say something, it means I agree with the previous panels. But one thing we haven't touched on is the actual cost of the available senior debt. If you're lucky enough to have an alternative fund that is fixed interest, that is an advantage, and you can lock in the situation. But when SOFR is now 4.8 today, even people like Macquarie Bank, which say they are open, and other institutions that say they are open, it means their cost of capital really starts at 8% or more. So I think the issue for us in Asia, because I think that if we were talking about Northern Europe, some of the banks that have left here, people like NIBC and DNB and others, not DNB hasn't left, but in terms of Asian exposure limited to their current clients, they are still lending to oil and gas existing clients with a Northern European focus. Our challenge, as Vivek said and others, is that the local banks in whatever jurisdiction, Malaysia, etc., for mid-market is virtually non-existent against name lending. So where you have some positive things is you do have alternatives that have come into the market. They will start at that sort of pricing and above. So even, in fact, we have one group, Gordon Brothers, that started its life as a retail industry lender, and they've actually, to our fortune, focusing now on offshore energy by hiring an expert based in London. But their capital will start in the low double digits. So it does come down to the fact that now the smart thing that people like Marco Polo and Kim Eng did and others in terms of balance sheet repair and keeping their powder dry, what I've been saying to our clients is look at those sources as less dilutive equity. And the fact that we're seeing more Middle East private equity coming into this space means that then founders who want to stay in the business in Asia can then get access to the Middle East money, which is not available for, say, Singapore companies if they're purely in Asia. So I think there's a holistic view now in terms of tapping grant money where you can for expansion, tapping alternatives, and looking at equity as essentially a solution. We've been talking about consolidation now for so long, and it's happening. Vessel values are going up, but in the middle market in Singapore, and I can only speak for that in Malaysia and other places, it's so tough, and it's very frustrating because people can see the opportunity and they can't get the low-cost senior. There's a lot of equity out there, there's a lot of mezzanine type money, but what we're missing is that sort of role that, say, a DVB was playing, where you could get some strategic senior to fuel the growth of local companies, and obviously people like Australis are filling that gap also. And some other players, M&M Bank and others, but they've each got their own criteria. People have not forgotten they got burnt, and so some of the times they're asking for long-term contract coverage, which in this part of the world doesn't exist in OSV. So we struggle then to meet the criteria, forgetting about advance rates and the like. But the investment opportunities are there, but I know that I speak on behalf of our clients, and we've even gone back to Enterprise Singapore and saying we do need to look at this because we need to find a way forward. Offshore energy is still a large employer of Singaporeans. It's a significant area of focus, and we just need to find that gap in that senior debt side. But Christoph, your thoughts?
Just before you speak, I mean, that definitely accords with what we're seeing in the market as well. I mean, name lending for the top names is always there, always has been, and continues to be popular.
Just one last thing is, I was going to preface my comments by saying I only speak on behalf of mid-market. What was amazing about Martin Brown's contribution at the start was that he was saying he's feeling it as well. So if he's feeling it, and I think the powers that be need to come to the table.
Yeah, no, absolutely. So the name lending is there, the long-term contract-backed lending is there. What doesn't seem to be there is anyone willing to take any kind of asset risk on the assets themselves, which is interesting given that we do seem to be at the start of an uptick.
We're doing that.
Over to Christoph.
I want to keep it short, but Elias obviously mentioned already. So it's been one of the very active areas for Australis Maritime in the last 12 months to take asset risk. We did obviously also focus still on contracted cash flows for some of these assets, but we had an underlying positive view for the sector, and that's why we were willing to underwrite risk that maybe others didn't. And also credit to our own investors. They were also willing to take oil and gas into the book, because that is one of the other problems in the sector, is that a lot of capital can't deploy anymore into OSV assets. I mean, just an example, we have 2 PSVs, dual fuel, a hybrid package on board. So they are the most efficient from a carbonization standpoint, efficient vessels out there. And we have some yard credits still on them. We used to bought them as resales. And we went to a fund that is focused on financing only those vessels that are in the top 5% of the market in terms of their CO2 footprint. So we went to them and said, look, here is a vessel or 2 vessels that they're in the top 1%. We would like to raise some debt. And they said, love these vessels, but they're working in the oil and gas market, so we can't finance them. So they're the most efficient vessel that you can have in the oil and gas market, but we can't finance them. And that's an issue.
Yes, I guess we are sanguine but circumspect. We realize that sometimes, I think what COVID has taught us is that market can turn very abruptly. The impact could be prolonged. And most of the financiers, I think they are lending not against assets, but lending against cash flow. So that will necessitate that you have a long-term contract. But from an owner's standpoint, we are also hesitant about entering into a long-term contract because the market is rising. You don't want to be caught. You are locked in at this rate where sometimes costs could be going up. So it's a delicate situation that we are seeing now. But in a way, we don't want to sound too bullish. We don't want to invite competitors to counter-compete against ourselves. But we are seeing that the cash flow generation is very fast. So equity is probably out of the picture because most of the owners are probably still trading below below the book value. So there could be, I think the alternative financing should come in, but we are also actually quite circumspect about it. Although our margins is like 30%, 40%, we can easily absorb that 3 percentage points increase, but it can turn very abruptly. So yeah, we'll see how it pans out.
Maybe just from our kind of perspective, obviously there's a lot of scar tissue in the industry here, and the finance industry here for lending. I think owners have been enjoying several quarters of good cash flows. I think the more of those quarters we have, the more positive the sentiment will be. But it's not just the recovery in rates that's important. When the market crashed, the change in commercial risk that occurred on contracts maybe went under the radar a bit in some circles, but it still hasn't really been clawed back. And things like early termination, right? So it doesn't really matter what you say your backlog is. Many of the banks here will just see through it if you have early termination clauses. So the ability to actually change some of that risk profile, and that's been very, very difficult from what we understand for most of the owners here to actually get their E&P customers to reverse that. But if we are able to do that, it might change the picture as well.
Yeah, we've had a number of queries just over the last 2 weeks about early termination and termination for convenience clauses and our views on how likely they are to be exercised in the market and those kind of things. So yeah, it's still clearly very much a live issue and a very difficult one to deal with while those clauses are persisting. Yeah. Vivek, did you have anything to add on the financing side?
Not particularly on this, but given the rate lock-in that Chong was just mentioning about, 2 weeks back we had a Petronas tender on IRM 5-year campaign, and we went around asking owners, do you want to commit a vessel for 5 years? I said no. So we out of most of the owners we had, they had 11 vessels requirement across 5 years. We were able to get one owner who's only willing to commit a rate for 2 quarters this year and the rates won't stand for 2024, we'll have to renegotiate. Um, most probably our bid will be rejected because we put an ad this. I can't take a risk for 4 years of, I don't know where the market will go. I can't take a 4-year risk on, owners won't give it. So chances are that our bid will be rejected, but I'm still wondering who are the other owners who put the kind of bid. So I'm very curious to understand where that whole tender will go. Historically, we have seen in the last 8-9 months, because of budget constraints, a lot of tenders have been cancelled after receiving, because the price at the budgets at which they received to what was internally budgeted have not a 10-15% play around window, it's like 30-40%. So it's going to be a challenge. So coming back to the banks will always want to see a no cancellation clause, and a oil company today requiring the asset will commit to any rate even on a long-term basis, but want to see a cancellation clause at the moment then the market turns, they're willing to get the vessel out of the contract. So I don't know, it's a catch-22.
Lax, we haven't heard from you yet. What are you seeing in terms of the market and where the crunches are?
No, I think personally, I was kind of aware of this contract actually because you used to be in the chartering side. So just to add some value into that, is that a lot of times the bidders would be submitting assets and getting the necessary letter of supports and authorizations to win the bids. And then when it comes to the actuals in fixing the assets, they'll swap. It's a bit of a bait and switch methodology where you get an asset in fit for purpose, and then if it doesn't work out, then you kind of swap that with something else around the market. So I think that for a lot of the competition in the market in Asia, owners tend to do that, and it's a bid strategy which has been engaged and employed for a long time. And I think it'll continue to be the case moving forward as well. So IRM campaign basically lasts for 30 to 45 days. Depends on what sort of work it is. It could be a sub-pipeline rectification program, or free span correction, or grouting services, or whatever it might be. And that's where Petronas, specifically for Petronas, realizes that they need fulfillment for assets, and then they'll go out to the market and look for other owners when it comes. So I think the key thing in the market as well is, apart from this, is to have to maintain a tight market, so owners do not go out and flourish too much in terms of building, having too many new building orders. So I think there have been quite a bit of new building orders in 2021, 2022. There's been an increase, I think double digits, and I'm not exactly sure what's going to be the case in 2023, but I can expect that to be the same. So if there's going to be increment of asset class in the market, that would spell that rates would kind of normalize in the long term as well. So obviously I'm not coming from an owner's perspective, but I can imagine an owner would want to keep those rates quite high, so they could actually enjoy those rates for a longer span of time. From my personal perspective, in terms of the oil market, traditionally during COVID, we've seen a lot of credit seekers, so we understand the market has been quite tough. So we tend to glance at obviously the audited financials and have a perspective if this person is creditworthy or not. And then we had the notion, when the market is actually ramping up right now, we would have thought that these guys would also be able to stomach the OPEX of fuel, but apparently it's not the case yet as well. So it's on one hand where everyone thinks that the market is going up, and it is, but the cash flow is key, and the cash flow isn't there. So I still think the OSV has, to draw a correlation, I still think there's still a runway moving forward, so maybe another 3 to 5 years growth. Yeah.
Yeah, well, it certainly doesn't seem that we're entering the territory of speculative building yet. So I think that's
Not at all.
that's a way off. So hopefully we're safe on that front. In terms of where the tight spots in the market are for where you could foresee a real shortage of vessels, does any of the panel have any views in terms of where those crunch points might be? Tom, perhaps you could start us off.
I mean, the GCC is the market where there are crunch points right now, and there are orders happening right now. There are new build orders, quite a lot of them happening from local owners in Saudi. A lot of the risks we talk about here just don't exist there. You have the strongest counterparty in the world. You have 5-year contracts. You don't have COVID risk because you don't need to move into other jurisdictions, other countries, if that were to happen as well. And that's why a lot of these guys were insulated. So local owners there, Zamil, Mwabi, these guys, they're placing orders for a variety of different asset classes. Some of these going a bit under the radar. They're also hoovering up what's in the S&P market as well. So that's the number one market where there is tightness already. And then when we move into the larger PSV segments as well. So that's really kind of for the 4 to 8 brake horsepower anchor handlers. But there is this increased requirement for the 2 to 4 deadweight ton PSVs in that part of the world. So again, that's a market that is, there is some slack, but it's getting tight very quickly. And then in the larger PSVs, West Africa has been a quick twitch in terms of the recovery, but longer term, structurally, Latin America, massive amounts of investment in Brazil, unprecedented FPSO orders. When you bring Guyana and Suriname, a bit longer term into the mix, that's certainly where a lot of the international guys are getting very excited about. So those are the first kind of 2 crunches, and then the larger anchor handlers have kind of, well, I suppose they've been a little bit more lackluster compared to those asset classes, but there's a lot of very good fundamentals there as well. You're certainly seeing the pickup again because of the FPSOs, again because of the semi-subs, and this picture or this story around offshore wind, which people are drawing. But I would say that right now offshore wind is about 4 to 5% of global activity for the OSV fleet, and it is quite localized in the Asia region. It won't necessarily translate for fixed bottom. Floating is the great equity story, but huge technical challenges to delivering actual scale, commercial scale floating wind.
In terms of Brazil, how are things looking over there in terms of local flag capacity? Because obviously once that's used up, it really opens the market up to the foreign flag vessels.
We talked about scarring in the finance market. There's still a level of scarring in what happened in Brazil with blocking, right? And the same thing will probably happen again, to be honest. And it's just a case of everyone knowing that it will happen again and looking to protect themselves as much as possible. Of course, there is increasing scarcity of locally flagged tonnage to support what's going to happen. There will not be enough to support what is already being built and will be delivered over the next 5 years, what Petrobras have committed to. So there will be opportunity for internationally flagged vessels. It's just hopefully going in with at least one eye open this time.
Christoph, did you want to add something?
Yeah, in terms of the markets where the tightness is developing, I mean, we believe quite strongly that the large anchor handler market will get tight. I do agree with the comment from Tom that there are huge delays, there are huge technical challenges still for the floating market. But I think the floating market really is where a lot of focus will happen in the next few years. The last round of awards in Scotland, more than half of the awards were for floating wind. It's probably still 3 to 4, maybe 5 years out. The challenge also in the larger anchor handler market is that the replacement cost of these vessels is significant, is huge. And so the cost to build them, the earnings where they are right now, I mean, we don't see anyone really building any ships there. And so and then also you look at the top end of the market, which is really where the floating wind will come in. It's about 50 vessels. And the projections are that maybe in 3 or 4 years' time, 15 of them are going to be in floating winds on a more or less permanent basis. So that's going to get really tight. So that's a market where also eventually new designs are being developed already, but the building cost is so significant, and we can't yet see the long-term contracts developing that actually allow owners to build these 100 million plus type assets. So it's probably a very tight spot eventually. Yeah.
Just add to that, because it's a really interesting point here on the larger anchor handlers floating wind, because people just assume they'll marry together. The current larger fleet is not that optimized necessarily for what people want to do with these. There's still a lot of dissent around how we're going to do operation maintenance. Will we tow back to shore? Exactly how we're going to install these things. So the actual level of activity is still relatively unclear, although there's lovely hockey sticks across the industry. And again, can we finance these from oil and gas cash flows as an oil and gas business? Probably not going forward. the depreciation schedule will just be too difficult for an anchor handler. So do we see a new classification, right? Are we going to call these things HTs? Maybe not. Maybe there's a new acronym that comes into play for a very similar vessel type.
Yeah, that's an interesting point on the depreciation. I mean, obviously that's another impediment to the new build sector at the moment in terms of how do you take a view on a 20, 25-year asset in the current oil environment. What's the views of the panel as maybe a final question, because I think we're already slightly over time, in terms of whether there may be a bit of a kickback in the market. At the moment, obviously, it's all about renewables, it's all about wind, it's flavour of the month, it's where all the activity is. But do you think that it's been overblown? Is the rumours of the demise of oil and gas overblown? And will we have a bit of a pushback and a resurgence in oil in the next 5 to 10 years? Anybody want to comment?
I guess the first point is that capital resources is finite. I think those people who want to invest in this sector only have X amount, and the offshore wind is sucking up a lot of this capital. So then the rest are, of course, to the more traditional forms of financing. At least in the Middle East, there is, of course, there's new exploration, then there's maintenance, there's production. So across the whole entire fleet size, I think we see a lot of demand in this regard. But having said that, I think the returns have to match the risk that we are taking, and hopefully we would have this delicate balance where demand supply would be supportive for the existing owners. Offshore wind and all, these are very costly investments, and eventually it will translate to, our view is that renewables and fossil fuels, they will have to coexist. So from our point of view, at least in the Middle East, we see it to be quite sustainable, at least in the mid-term, at least for the going forward.
Well, just I guess on the depreciation, that's one of the biggest challenges here. In previous cycles, the 25-year asset life, okay, you can sell that, but right now an oil bull can sell a 10, 15-year oil story, but what will the market look like in 25 years? Extremely hard to kind of say that oil demand and the oil price will be where it is today. So you're going to have to go with a 15-year depreciation schedule, and that changes the economics of the new building, and it means that you need better KPIs today than you needed in 2014 and 2007 to build. So getting rates to where they were, it's not going to be good enough to see a new wave of at least, of new buildings. So yeah, so quite a way away.
Yeah. Okay, fantastic. Thank you very much to the panelists. Give them a round of applause.